Joining us now to discuss the outlook for central banks is Anthony Chan, former Chief Economist at JPMorgan Chase. Great to see you, Anthony. Thanks for joining us. What is the most significant message from recent central bank moves?
I think the most significant message is that central banks are paying attention to their inflation targets. And as a result, they need to see real economic weakness before they lower interest rates further from here. Of course, we see that even more in some countries like Japan, where they've been battling the inflation numbers that have been consistently above the target. And so they are gradually moving. But remember, the Bank of Japan had much lower policy rates than other central banks around the world. So the burden for them is even greater than it is for other central banks. But all of them are fighting to maintain those inflation targets.
And why is the BOJ's decision to raise rates to a 30-year high so important for markets?
Well, I think it's important because otherwise the credibility of the central bank is at stake, given that the inflation target of 2%, they haven't met it for quite some time. And relative to that policy rate, it does, in fact, justify some normalization of rates. Unlike in the United States, where, yes, inflation is running close to 3%, but the policy rate is much, much higher. So they have a little bit more room to maneuver.
The US Federal Reserve may cut just once in 2026. What risks does that pose?
Well, I think that at this stage, because the policy rate or the federal funds rate is high enough, that if they cut interest rates once or maybe even twice, the risk is not as great because policy rates are still somewhat restrictive. So they certainly have the room to cut rates once. And if the labor market becomes significantly weaker, they have some flexibility to go twice. But again, a lot of the cuts have already been made. As you said earlier, the Federal Reserve cut rates 3 times this year, and they cut rates in 2024. So they've already cut rates by about 175 basis points. So again, they've done a lot of the hard work in terms of trying to lower that interest rate so it's not overly restrictive.
What does the European Central Bank's pause signal about euro-era inflation and its growth?
Well, at this point, I think the eurozone is in a sweet spot because you have the policy rates that are lower than in the United States, but inflation is much lower. So at this point, they're at a situation where economic growth is not robust, but inflation is not really a problem. So they are at a point where they have the luxury of being able to pause and pause for some time unless economic growth really comes under real threat. And so far, I think they're in a good position, but that could change. I think that even though the likelihood of them keeping interest rates stable in 2026 is high, if they see that economic growth comes under pressure, I think that they could actually consider a possibility of lowering interest rates one more time.
What about the BOE's narrow 25 BP cut? Did that surprise some, and why?
It did surprise some because you could see it was very close, 5 to 4. Inflation is much, much higher in England, and the policy rate has been cut. So at this stage, they are realizing that the economy is under significant pressure, but inflation pressures are also lurking behind the scenes. So moving forward, I think that there's a higher probability that they cut rates than, say, the European Central Bank, but they have to be very, very careful that they don't do so to the detriment of their inflation target.
And G10 central banks, how are they diverging in policy right now?
Well, I think that right now you can see that many of the G10 central banks are paying much more attention to inflation. In the United States, there is a lot of political pressure coming from the White House to cut interest rates, despite the fact that the inflation rate is still almost 80 to 100 basis points higher than the target. But again, that political pressure is causing a lot of pressure on the central bank. And already they've been adjusting reserves, the Federal Reserve is going to be buying $40 billion worth of bonds every single month for the next couple of months, 4 months. Even though I don't consider that quantitative easing, it's a little step in the direction of making sure that reserves are ample and it doesn't put upward pressure on short-term interest rates.
And just quickly, Anthony, how comfortable are central banks with current inflation trajectories?
I think that at this point that there are some central banks like the Bank of Japan that are not comfortable at all with the inflation rate. You've got the European Central Bank that is much more comfortable with inflation. And I think that the Bank of England is sort of teetering on the edge of not really being comfortable with the inflation rate, but they also want to make sure that they don't put overly too much downward pressure on the economic growth or the labor market.